Welcome back, everybody. The market's up to all-time highs again, and there's a lot going on. So we have a ton to talk about today, including some new ETFs that are on the way, targeted at individual investors that, well, make me think of this.
They give you the bonds they want to sell. They give you clients. They give you money to run your business. Give you fat fees for doing so. But you represent the investors? Is that right?
Yeah. Also, UnitedHealth announced earnings that looked pretty good, but still dropped about 10% on the day, due partially to a data point that we've been following on this channel. Plus, ASML earnings leaked and the stock has dropped 20% since, causing people to say that the AI bubble is starting to pop. But then TSMC announced earnings and, well, maybe not. Lastly, we'll end the episode with Stanley Druckenmiller admitting that sometimes, well, he's just kind of like the rest of us. So let's go ahead and get started. Now, first off, I wanted to start with this article in the Wall Street Journal. It's called CLOs Are So Hot Right Now, They're Getting ETF'd. And I'm just going to say right now, that headline alone should raise some red flags for you. But let's actually dive into what it's talking about. So it says, low-rated corporate loans are having a banner year. Wall Street is trying to find more ways to sell them to ordinary people. And says BlackRock and Nuveen have recently asked permission from the SEC to launch new exchange-traded funds of collateralized loan obligations. And now you might be like, okay, what is a collateralized loan obligation? So a collateralized loan obligation is a single security backed by a pool of debt. Collateralized loan obligations are often backed by corporate loans with low credit ratings or loans taken out by private equity firms to conduct leverage buyouts. And so just off the top, when you hear collateralized loan obligation, it probably reminds you of this.
A collateralized debt obligation. It's important to understand because it's what allowed a housing crisis to become a nationwide economic disaster.
And they talk about it in the article. They say securities made by bundling junk-rated loans together. Those will join about a dozen CLO ETFs that have already entered the market in recent years and now have about $16 billion in assets under management. And they go on to talk a little bit more about the process here. Investors in CLOs aren't buying the loans themselves, but rather floating rate debt securities used to purchase the loans. Those come with varying credit ratings and offer disparate yields, with lower-rated, higher-yielding securities at greater risk of losses when the underlying loans start to default. A major appeal of CLO securities is that they tend to offer higher yields than comparably rated corporate bonds. For example, AAA-rated CLO securities currently yield about 5.6% on average, while single-A corporate bonds yield around 4.8%. And they do talk about here that there's a great demand for yield, especially from assets that aren't so exposed to inflation or big swings in interest rates. We think that CLOs fit the bill, especially within a wrapper like ETFs, where you have greater transparency about what's owned. But with everything, let's talk about the actual risks. Major risks include the threat of an economic downturn, as companies with weaker credit ratings would be among the first hit in a recession. Corporate defaults would likely hit loan repayments, and a downturn could also drive investors to pull money from floating rate investments because they expect the Fed to cut short-term interest rates to spur economic growth. Your potential for defaults and credit losses would go up at the same time your yield is declining. And I think this kind of hits on my major concern with this type of product, which I know these products apparently already exist, but there's new ones coming on the market. Now, first off, in general, I'm a free market believer. Like at the end of the day, if there is a market and demand for these products and people want to put their money into them, I have no problem with that. Like that doesn't bother me. The reason why I think these are a little bit of a concern, depending on how they're marketed and how popular they become, is that in my experience, what I see a lot of times is newer investors get kind of pulled into this high-yielding investment asset craze, right? And maybe craze is the wrong word. But one of the reasons why I did my JEPI video and I did my Yield Max video is because I was getting asked about those things so much because people see it, they see the high yield. For some reason, those products are ones that people online really push really hard just to be like, hey, look, I'm getting 9% yield on this thing. And the issue with that is that people don't always address the risks with investing in a high yield asset like that. Like if you're in the situation where you truly have an income-based investing strategy and you understand the risks of that, you understand the opportunity costs of that, and it's one of those things where you're eyes wide open knowing what you're doing and why, then there's absolutely no problem with it, right? It makes total sense. And that's what I said in my JEPI video about how it's not right for most investors because most investors are just trying to invest for retirement. They don't have a specific income-related strategy. They don't understand the opportunity costs that they're missing out on by investing in yield now as opposed to growth over over a period of time. And to me, the issue with an ETF like this is I think the risks that come along with it are probably outside of the comfort level of most individual investors, at least most individual investors that watch this channel, right? Because think about it. If a major downturn could be a big risk to the ETF because it impacts the underlying corporate bonds or the companies that issued those corporate bonds, well, that's something that's going to be very hard to predict just from a macro level, right? But then you add on to that, well, if the Fed keeps cutting rates, that could also impact your yield. And then on top of that, what are these junk rated bonds actually made up of? Like what type of companies are these? How healthy are these? How many people are going to go into that step of really digging into what they are? Probably not very many, I'm guessing. Because again, this idea that, if you package a bunch of poorly rated things together, then now it's more diversified and it's less risky. I mean, we've heard this before.
You want me to really blow your mind? When the market deems a bond too risky to buy, what do you think we do with it? Take a guess.
I don't know, you tell me.
All right. You think we just warehouse it on the books? No. We just repackage it with a bunch of other shit that didn't sell and put it into a CDO.
A CDO?
Yes, a CDO.
What is that?
This is where we take a bunch of Bs, double Bs, and triple Bs that haven't sold, and we put them in a pile. And when the pile gets large enough, the whole thing is suddenly considered diversified.
So ultimately, from my perspective, just like anything, education is going to be key with this, and maybe something that I dig into a little bit more when they actually do come out, like the BlackRock versions come out, just to see what's actually in them, maybe make a video to help people understand what the actual risks are. Now, I'm curious how big the target market is for this. Like, are there a lot of individual investors that really understand these risks and the ability to dig into what these things are? I don't know. I'm curious to hear y'all's thoughts, so let me know down in the comments. All right, so next up is UnitedHealth. Now, they reported earnings this week, and on the surface, they look good with beating on earnings per share and then also beating on revenue. But the stock dropped about 10% on that first day and has kind of slowly been inching back up since. And the reason why people are speculating is because medical costs continue to surge more than expected for health insurers. Now, if you watch this channel for a while, then this actually shouldn't be a surprise to you because, as you know, I had UNH in my portfolio and I sold it earlier in the year, and I wrote this whole big long thing of why. But the main reason was I was concerned with costs rising in the business and not really seeing an end in sight just based on where U.S. healthcare is right now. And here's what I said about it before. But one of the things that I was watching when I held this stock was their care ratio, which is basically the ratio of benefits that they've paid out versus the claims that they take in. And this number has been steadily rising for a while, and it was one of my big concerns with the company. Now, in the most recent quarter, it was 85.1%, and they have a lot of different reasons why in terms of the one-time impacts that they're dealing with. But overall, this has been a trend for UnitedHealth that is more than just this past quarter. If you look back over the past few quarters, you can see that it went from 82.2% in Q1 of 2023 to now 85% in Q2 of 2024. And while there's been a little bit of fluctuation, in general, the trend is up. And why this is important is that policy premiums is the largest part of their revenue. And what we see is that their expense growth has actually outpaced their revenue growth over the past year or so. Because both in 2023 as well as trailing 12 months, their revenue growth is actually slower than their expense growth. Now, to be totally fair, UNH is still up about 10% even after this drop from when I last sold it. So it's not like I came out looking great in that deal, but I said that I thought it was the best managed healthcare stock out there. It's just I decided I didn't want to be in any healthcare stock anymore. But I think the main question going forward for UNH holders or people that are interested in the company is whether or not you believe their cost and care ratio is going to continue rising, or if it's a temporary issue that will start to come back down at some point. Now, I was worried about the care ratio. That was one of the things that I was monitoring each quarter, and it just continued to go up. And so that was one of the driving factors for me saying, I don't really want to be in this anymore because I just can't see that going back down. I think medical care and costs for medical care is going up. I think the ability to charge more is something that's going to be very politicized and very unpopular, kind of on both sides of the aisle, if you want to say. And I just really struggled with understanding what the future was for a managed healthcare company in the US. Now, part of that is my own ignorance of that industry, and that's one of the reasons why I didn't want to be in it. I don't understand it all that well. So I'm curious to see how it plays out. Now, again, if you like UNH, you should keep UNH. Most people are very bullish on the company, but those are the reasons why I sold. And I thought it was interesting that even though the care ratio has been going up, this isn't a new thing, that all of a sudden people are like, oh, it dropped 10% because of the care ratio. Now, we never really know why a stock drops. If it is because of medical costs and continuing to go up, then it's something we'll just have to watch and see what it does over time. Now, speaking of stocks dropping, let's talk about ASML. The Dutch semiconductor equipment company has fallen around 20% since their earnings were accidentally published earlier this week. And it showed that they had bookings that fell 53% quarter over quarter. Now, quarter over quarter isn't always the right way to measure something. I think it's happening a lot in the AI space and the semi space because the growth has been so crazy. However, a 53% decline or missing estimates by about 50% is a lot, and that's why it caused so much concern. And at first glance, this caused some folks to immediately be like, hey, I thought AI demand was infinite. And this was a really great example of how you can see stuff online that just has no basis in fact whatsoever. Because ultimately, ASML sells equipment to make semiconductors, not chips themselves. Plus, their business includes bookings for non-AI related chips. And in fact, their slowdown, according to them, was caused by the slowdown in non-AI related chip bookings, with AI chip related bookings continuing to see strong demand. And speaking of that strong demand, Taiwan Semiconductor, or TSMC, reported earnings this morning and basically said AI demand is strong and boosted their future outlook, which had the stock up over 12% this morning. And to me, this was a great example of, you just can't believe everything that you read, right? The information's out there. We have the ability with the internet now to dig in as much as we want. And I think, when we're investing our own money, it's our money at risk, right? So taking anything that anyone says, even if it's me at face value, is probably not a good idea, right? Like in that case, it was completely wrong. It was kind of implying that AI demand was slowing, when in fact, it was the exact opposite, right? So that's why you can't just go by what you hear in the clips and the headlines on some random tweet on social media. It really is important to dig into these things and find out. And I think sometimes we let our own bias of what we think about a company or an industry maybe change our perspective of how we take information, right? So when you see that ASML was down 50% in net bookings, people automatically assume it's AI because they believe AI is a bubble or they think it's nonsense, right? Where, to me, that's an opportunity to really say, let me dig into this a little bit more, right? Why are the bookings down 50%? Because if you just tell me that bookings are down 50%, I don't know if it's a good thing. Well, it's never probably a good thing, but I don't know if it's automatically a bad thing or if it's a temporary thing that's not a problem. Without more information, it's impossible to know. And so when someone comes out and says automatically, hey, look, I thought AI chip demand was infinite, and then you dig into the details, it's like, well, actually, AI chip demand was good. It was the non-AI chip demand that was slower and caused a decline in bookings. And then a couple of days later, Taiwan Semiconductor comes out and blows out estimates because AI chip demand is super high. And ultimately, I look at it as my money at risk or it's your money at risk. And I'm just of the opinion of I'm not going to overreact to a headline one way or another. I'm going to wait and see what the underlying cause is, or try to understand what the underlying cause is, then try to make an educated decision one way or another. But the more that we can kind of get our own bias out of the way, then I think it really helps us as investors because, in this case, it was easier for me because I don't own ASML. So I had no emotional attachment to them whatsoever. I just saw they were down 50%, which is crazy. I saw the stock went down 20%, which is crazy. And I'm just like, okay, well, let me find out what's going on. And for me, the question is simply, all right, is this demand issue in the non-AA side a long-term problem or not? I don't know enough about them to know, but those are the type of things I would be digging into if I was interested in ASML. But again, I think it's understanding the nature of content, the nature of media, and just adjusting our process accordingly because it's our money on the line. Okay, so lastly, along the same lines, if you remember back in May, Stanley Druckenmiller was on CNBC and he said this.
I said in an interview in June of that year that I expected to own NVIDIA for 2 or 3 years, that this was a mega trend like I'd never seen, potentially bigger than the internet. But when the stock went from 150 to 900, I'm not Warren Buffett. I don't own things for 10 or 20 years. I wish I was Warren Buffett. And 150 to 900, yes, we did cut that position and a lot of other positions in late March. I just need a break. We've had a hell of a run. AI might be a little overhyped now, but underhyped long term.
And this caused a lot of folks to assume that NVIDIA's run was over and things were about to pop. But since then, though, NVIDIA's up almost 50%, and Druckenmiller was on Bloomberg saying this.
I've made so many mistakes in my investment career. One of them was I sold all my NVIDIA, probably in somewhere between 800 and 950. I think it's 1,300 on that stock now.
You own none today?
I own none, and I own none the last 400 points. It was a big mistake.
And here's the thing. Stanley Druckenmiller is a legend with an amazing track record, right? And if you actually went back to that CNBC video that he did, because I remember watching it at the time, he wasn't really bearish on NVIDIA at all. He basically said, we made a huge return in a short period of time. He thought that AI was undervalued in the long term, but maybe a little overvalued in the short term. And so he told you right there that he's still a believer, but he's like, look, I bought it at 150. It's up to 900. We're taking profits, right? And at the end of the day, you bought some for 150. It's up to 900. It would probably be irresponsible not to take profits in that case. But for me personally, I never looked at him selling as a negative for my own NVIDIA holding because he said in that interview, he's bullish long term and he may own it again. And I thought this was another really great example of how sometimes we can just overreact based on the decisions and actions of these legendary investors. And that's because, of course, they're legendary investors, right? Like we're trying to get some alpha from them. But we have to remember that their timeline may not be our timeline, or their situation may not be like our situation, or their goals may not be like our goals. And probably most importantly, they're human as well, so they may even make some mistakes. So if Stanley Druckenmiller can go on Bloomberg and say, hey, me selling NVIDIA was probably a mistake, then I think you and I can forgive ourselves for those buys and sells that didn't quite work out the way we expected. Because remember, it's not about getting all of them right, it's about continuing to swing and letting time and probabilities do their job. Now, if you guys are curious how TSMC and NVIDIA kind of play together in the different kind of sections of AI, then go ahead and watch this video right here. Hope you guys have a great day out there. Financial independence is true freedom. So keep building and stacking wins, and I'll see you on the next one. Peace.